As always, let's take a minute or two to read through this problem to make sure that we all know what we're looking at here, okay? So this corporation acquired as a long-term investment $320 million of 4% bonds. The company has the positive intent and ability to hold, so normally that would be held to maturity securities. But when the bonds were acquired, they decided to elect the fair value option. That immediately means that they have to call them something other than held to maturity. Think about that for a minute or two. The market interest rate for the bonds was 6%. So the 4% bonds sold in the 6% market. Tanner paid $290 million for the bonds. Semi-annual interest payments June 30 and December 31. And as a result of the changing market conditions, the fair value of the bonds at year end was $300 million. So, first question, it says, how are they going to handle these? Well, because they've elected the fair value option, they can't use held to maturity. Okay? Available for sale has to be indicated as such, so they can't use them. And besides, they told us that they're going to elect and use the fair value option. Well, significant influence never applies to bonds. And I don't know what other securities are. You elect the fair value option, you by default say these are trading securities. Okay? So, that's the first part of this problem. Then part 2 says, what's the journal entry to record their investment in the bonds? Well, there's no big mystery there. We bought $320 million worth of bonds. We paid $290 for them. We have a discount of 30. Okay? Simply just plugging in the information. The next thing they ask us to do is they say, let's take a look at the journal entry to record the interest on December 31st. Okay, so we can do that. So first we need to figure out how much cash we're going to get. So it's 4% face value of the bonds times 320 mil. But this is twice a year, so we got to divide that by 2. So when we do that, we come up with 6.4 mil. So that's how much cash we're going to get. Now, remember, these bonds were sold at a discount, so we have to figure out what they should be paying. Okay, so that's the actual interest revenue is the 6% times the carrying value, what we paid for them, $290, divided by 2. That's the actual interest revenue. And when we do that, we come up with 8.7 mil. The difference between those is the amount of discount that we are going to be amortizing, recognizing, 2.3. And it's just a plug number. Just subtract the interest revenue from the cash, and the difference is discount or premium, depending on which side it's on. Okay? So, that's the first 3 things it asks us to do. Let's take a look at the next couple of things. Next thing it says, problem part 4, it says, what do we do? How do we recognize the fact that at the end of the year, remember the last thing they told us, at year end, these were worth $300 million. So we have to figure out the fair value adjustment, and the fair value adjustment is the carrying value of the bond minus the discounted premium, okay, all of that, and therefore we have to figure that out first. So we had the $290, right? That's what we paid, and then we added to that $290 the 2.3. Remember the discount that we used over here, the 2.3? Okay. So the carrying value of this bond is $290, the purchase price, plus the 2.3 mil. So the carrying value to us is $292,300, or $292,300,000, or whatever that works. Okay. But we're told that the value of the bond at the end of the year is $300. So the difference between those two, the 92.3 and the 300, 7.7 is the unrealized holding gain or loss, and in this case it's a gain. So fair value adjustment to the asset, 7.7, and the net unrealized holding gains or losses, this happens to be a gain, so this would act like revenue, 7.7, and this goes on the income statement because these are trading securities. Now, after playing with your head for the first 4 parts of this problem, they ask you a question that makes you want to go scramble off and do a whole bunch of computations, calculations, additions, subtractions, multiplications, and divisions. But the simple fact of the matter is, they say, as of December 31st, the fair market value of the bond was $300,000. We chose the fair value method. We marked to market, so we're going to call our bond $300 million in the balance sheet. Okay, now the last thing says, suppose something terrible happens. Something terrible always happens, especially in the market and in accounting tests. And Moody's downgraded the risk rating. They said, this bond may not be as safe as we thought it was, and everybody wants to get out of it. So they all want to get out of it, so they're going to sell it. So the company sells the bond for $280 million. Let's just put it down. That's what they sold it for. Cash was, what we sold it for was $280 million. Okay, because they tell us that. Now, we still have some unamortized discount that goes away. Remember, when we originally bought this bond, we had bond, was it 320, I think? And we had a discount of 30. Well, we've used up some of that discount, but not all of it. Okay, so how much of that discount did we use up? We used up 2.3. So in our discount account, we have 27.7 mil still left. So that goes away. The discount on the bond goes away. 27.7. Our investment, face value of the bond, the whole amount of the bond goes away. And the face value of the bond, if you remember from the very beginning, was $320 million. Bond, $320 million. And do the gazuntas and the gazaltas, and you come up with a loss of 12.3. Now, at this point, we've gotten rid of the investment, so there are no unrealized holding gains or losses left. So, if you remember right, we did that adjustment at the very beginning where we debited fair value adjustment to increase the value of the bond and credit the unrealized holding gains. Well, now we have to undo that. So our net unrealized holding gains, we credited originally, we'll debit it, and the fair value adjustment we debited will now credit. Pretty good problem on bonds. The trick there is you had to know that these were trading securities because they opted for the fair value option.